Circle Internet Group, Inc., ticker symbol CRCL, is currently trading at $94.30, which represents a 4.07% decline, or a $4 drop from its last close as of November 12, 2025. This immediate, sharp downward movement following the release of the company's third quarter 2025 earnings presents a classic disconnect. The initial market expectation was clearly for a more positive reaction, given the broadly strong metrics the company reported. The true insight, the piece of information that creates that essential tension, is this. Circle absolutely crushed the consensus estimates for earnings per share, reporting 64 cents against a forecast of just 34 cents, and delivered a whopping 66% year-over-year revenue increase to $740 million. Yet the stock is pulling back hard. This isn't a reaction to bad numbers, it's a reaction to the forward-looking narrative and investor positioning. The reality is that the market is showing a deep-seated anxiety about the subtle shifts in future guidance, particularly around increasing operational costs and a potentially more challenging rate environment, which impacts their reserve income, the core profitability driver of their stablecoin model. Investors were positioned for a perfect report to justify the high-growth premium, and anything less than perfection, especially any indication of rising operating expenses or a cautious outlook on future interest rates, is being punished with a disproportionate drop, signaling profit-taking and a re-evaluation of its growth trajectory. The street was pricing in a continuation of the high-growth, high-margin story without much friction, but the stock's volume on this downtick suggests the bigger players are adjusting their models to account for a slightly higher cost structure and greater regulatory noise, even as the fundamental business continues its impressive expansion. This is the heart of the matter: incredible execution met by a reality of increased systemic risk perception in the stablecoin sector. The common ground narrative surrounding Circle Internet Group, Inc. for the majority of 2025, especially following its public debut, has been one of a foundational financial technology powerhouse, essentially the issuer of a digital dollar for the Internet age with their USDC stablecoin. This view paints them as a regulated, stable, and rapidly scaling alternative to traditional payment rails, with an infinitely expandable total addressable market. The expectation is simple. As the adoption of digital assets and blockchain technology for payments and commerce grows globally, so too will the circulation of USDC and, consequently, Circle's reserve income, the interest earned on the US dollar reserves backing the stablecoin. The logic is compellingly direct, and is why you see brokerage platforms like Robinhood and SoFi Invest making digital asset services a central feature of their offerings. They recognize the shift Circle is capitalizing on. However, the contrarian take, the deeper analysis that the market is now challenging with this price action, is that reserve income is a double-edged sword that creates a direct dependency on the Federal Reserve's monetary policy. If the central bank signals a quicker than anticipated move to lower interest rates in the coming quarters, the spread, the difference between what Circle earns on its reserves and its distribution costs, will compress, directly impacting the core driver of their profit margins. While the company reported a massive 108% year-over-year increase in USDC in circulation to $73.7 billion, which is a testament to their network growth, the market is looking past this success to the marginal profitability of that next $1 billion in circulation in a potentially lower rate environment. Furthermore, the Q3 report highlighted that while total revenue and reserve income hit $740 million, up 66%, the total distribution, transaction, and other costs increased 74% year-over-year, which is the line item fueling the anxiety. The question is not if the network is growing, but how much of that growth is translating into bottom-line profit when the cost of distributing and supporting that growing network is accelerating faster than revenue. This challenges the pure-play growth narrative and forces a re-evaluation of the premium valuation. The recent stock movement of CRCL has been a masterclass in volatility, particularly since its initial public listing. In the month leading up to this earnings report, the stock had already pulled back significantly, roughly 20%, which suggests a lot of smart self-investing traders and institutional players were already de-risking ahead of the announcement, sensing that the valuation had run too far too fast. This daily swing of over 4% on an earnings beat is not fundamentally negative. It's a necessary volume shakeout driven by what we can only assume is institutional selling pressure to lock in profits or adjust positions based on the nuance of the forward guidance. We've seen reports of major institutions like Vanguard Group Inc. significantly increasing their positions, yet simultaneously, key insiders are showing material sales, a classic divergence that creates massive short-term pressure. The combination of increased institutional accumulation, like the significant add by Sumitomo Mitsui Trust Group Inc., and the equally significant insider sales, creates an immense pressure cooker for the stock price. The buying is a vote of confidence in the long-term investment thesis of stablecoins as a utility, while the selling signals a shorter-term caution on valuation or market liquidity. This kind of high-volume post-earnings dip is where many retail investors, especially those using platforms like the Robinhood app for their trades, might panic sell, adding fuel to the fire. However, the sheer volume, coupled with the fact that the company still surpassed all major earnings estimates, tells a story of repricing, not broken fundamentals. The market is trying to find the stock's new equilibrium price point, where its incredible growth story is properly balanced against the macroeconomic reality of interest rate uncertainty and the competitive landscape with other stablecoin issuers. Zooming out to the company's business model, Circle Internet Group is fundamentally an infrastructure provider for the digital dollar. Their main product, USDC, is a fully reserved digital dollar, redeemable one-for-one for US dollars. Unlike many speculative digital assets, USDC's value proposition is its stability, transparency, and compliance. The core business is multifaceted. First, they earn interest on the reserves held to back the USDC in circulation. This is the reserve income, which, as discussed, is highly sensitive to the Federal Reserve policy. Second, they have subscription and service revenue through their developer services, which allow companies to integrate USDC payments and accounts into their products. This includes services for business accounts, payment APIs, and tokenized funds. Third, they generate transaction revenue from their payment network, Circle Payment Network, CPN, which is expanding globally, now active in countries like Nigeria and Mexico. Their strategy is to build the actual pipes, the online investment infrastructure for the future of money transfer, creating a network effect where the more widely adopted USDC is, the more critical Circle's platform becomes. This is a powerful utility-based business, distinct from the speculative crypto trading that platforms like Robinhood and Interactive Brokers offer for other digital assets. Circle is more aligned with the financial infrastructure side of the house, like a payments processor. Their long-term growth is tied less to the price of Bitcoin or Ethereum and more to the global transition of commerce, payments, and trade finance onto transparent, instant, and borderless digital rails. Their key older reports, particularly from the early periods after their listing, emphasize the exponential growth in USDC circulation and the high yield from their reserves, which set a very high bar for investor expectations. Their past performance shows a consistent trend of widening their lead in regulated stablecoin market share, and that trend is supported by their announcement of new partnerships with major financial institutions like Deutsche Börse Group and key global exchanges. This continuous institutional acceptance validates their commitment to regulatory compliance, a significant competitive advantage in the complex digital asset space. Looking ahead, the future outlook for Circle stock is defined by a distinct expectation versus reality dynamic. The expectation is a smooth, continuous upward trajectory, driven by the inevitable global adoption of stablecoins. The reality, however, is a much more complex picture filled with clear catalysts and pronounced risks. The catalysts: exceeding expectations on utility ARC network adoption. The company recently launched the ARC Public Testnet, a new Layer 1 blockchain specifically designed for payments and programmable financial use cases. If ARC successfully captures a significant amount of high-value institutional and corporate on-chain financial activity, it could create a new, high-margin revenue stream beyond pure reserve income, fundamentally changing the unit economics of the business. This would be a genuine, non-rate-dependent catalyst. International payments expansion. The rapid expansion of the Circle Payment Network into emerging markets and with traditional financial players like Unibanco Itaú demonstrates a massive opportunity.
Successfully onboarding the 500-plus institutions reportedly in their pipeline would solidify USDC as the de facto cross-border settlement layer, moving from a crypto-native tool to a global financial utility, making it a critical piece of global investment infrastructure. Regulatory clarity. While regulation is a risk, a clear federal stablecoin framework in the U.S. would be a massive tailwind. Circle has positioned itself as the most compliant player, and favorable legislation would essentially raise a regulatory moat around its business, differentiating it sharply from competitors, and potentially leading to faster adoption by large financial institutions who use services from companies like Fidelity or Interactive Brokers. The risks: falling short of the narrative. Interest rate compression. The most immediate and tangible risk is the Federal Reserve easing its monetary policy. A sustained, sharp drop in the Fed funds rate would directly and significantly compress the